Hey everyone, and welcome to 8 Minute Equity, a video series where we unpack the most pressing topics around equity in about 8 minutes. This time you're joining us for a conversation on IFRS 2. I'm Joe, I'm the content and communications lead at Ledgy, and I'm delighted to be joined this time by Ledgy senior product manager Alex Hare. So Alex has led all kinds of complex projects and product launches at Ledgy. And before joining us, he works on product at a neobank in the UK, Starling Banks. Hi, Alex. Great to have you with us.
Hey, Joe. It's great to be here.
Press 2, International Financial Reporting Standards. 4 words guaranteed to get your blood pumping. But as anyone who has experience running an equity plan knows, calculating the costs of share-based payments under IFRS 2 can be really painful. Alex, for people who may not be au fait with IFRS 2, can you provide a quick definition of what it is and why it matters for companies and for equity?
Sure. So IFRS 2, it stands for International Financial Reporting Standards. And basically what it is, guidelines on how you should account for the costs associated with your equity grants or share-based payments, as you just referred to them. Because ultimately, as a business, your equity grants do cost you money, and that affects your profit. So it's something that needs to be reported on your income statement. So this is basically the process of kind of accounting for your equity costs. And generally how you do that is you look at the number of shares that are vesting per grant and multiply those by a valuation for that grant using something like Black-Scholes or one of these fancy valuation formulas.
Super cool and a great starting point. I think some people might be wondering, we hear a lot about US GAAP as well as IFRS 2. So how do these two sort of sets of standards intersect and relate to each other? Are they kind of competitors almost? Is it best practice to try and adhere to both standards? Or should you pick one and try and go with that dependent on your geography or what matters to your business? Yeah, explain, please.
Yeah, usually you'll be going with one based on geography. I wouldn't describe them as competitors necessarily. It's primarily driven by where you operate. So if you're in the US, probably US GAAP. Otherwise, Europe or elsewhere in the world, probably IFRS 2. Sometimes regions do compete on regulation because it can attract IPO listings and things like that, but it's probably a bit of a stretch in this context. Yeah, I think that's what's driving this here. And just, I guess, a little bit more maybe context on kind of the differences and similarities between these two standards. Conceptually, they are actually very similar. They're both after the same thing, costs or expenses associated with your grants. And they both take a fair value-based approach to that. There are some differences you should be aware of and explore if you're making that decision. For example, under IFRS 2, you'll typically project your vesting using an accelerated method, whereas on US GAAP, you've got more of a choice to take more of a straight line approach. There are some things like that you'll need to think about.
A few points to bear in mind, but we're gonna stick to IFRS 2 for the purposes of this conversation right now. So there's lots of stuff with IFRS 2 that has maybe a bit of a scary reputation of being extremely complex. CFOs and finance teams might have grappled with Black-Scholes and other complex models and formulae, but even though there's quite a bit of hard stuff with IFRS 2, some people are surprised by the nuances that are involved with actually adhering to the standards and staying compliant. Would you believe we actually have a Benjamin Franklin quote for you? And he said quite some time ago, the great part of the miseries of mankind are brought upon them by false estimates they've made of the value of things, which some finance leaders might read with a sigh of recognition. Specifically when it comes to IFRS 2, companies do actually make a lot of estimates relating to forfeitures, terminations, other bits. So can you talk a little bit about that? What are the estimates actually that companies make? And what's the difference between a bad estimate and a good estimate? What are the consequences?
Yeah, some people might say accounting is both an art and a science. I think that's what you're getting at here.
Sure.
And so as far as I think some of the nuances that you need to keep in mind, if you take something like the Black-Scholes calculation, it's complicated math, but as long as you have the right inputs for that, it's something you can run. I think where we've seen more questions from customers is on things like, as you said, like terminations and forfeitures and keeping track of those properly. On the terminations front, it is important that if somebody's leaving the company and you're terminating unvested options, that the expenses get reduced accordingly.
Yeah.
But you can't change past expenses that you've already booked. You do need to account for that. It could result in a negative expense, which is perfectly okay.
So you can't go back and retroactively correct expenses. Is that right?
No, you wouldn't want to do that
Yeah.
for something you've reported in the past. So yeah, that's where I guess it gets a bit tricky. You're trying to project some estimates, but then when actual facts come in, you need to know what you've estimated in the past and true up for it based on the real things that happen. And ultimately what you do want to end up is like once someone leaves or a grant completes vesting, that you have fully expensed the actual amount that has vested. So yeah, there is some tension there between not knowing what's going to vest up front, but eventually knowing what that's going to be. Things like that can get a bit complicated. That's where software like Ledgy comes in handy. You know, it handles a lot of these scenarios quite seamlessly.
Yeah, so let's talk about the different kinds of grant types as well, because there are many different grant types when it comes to equity and share options that companies have available to them. At Ledgy, we cater for many different grant types adapted to many different markets and countries, from options to phantoms to warrants and so on. And actually, many companies, particularly those that are operating at scale, have multiple grant types in operation simultaneously. That might be dependent on geography. It might be dependent on something like you've reached the limit of your EMI scheme if you're in the UK and you need to search for something else. So can you talk a little bit about what changes when the grant type changes and how companies can negotiate that or navigate that?
Sure, yeah. So it's perfectly possible that you might have multiple grant types in play, and they can be valued differently. So the main consideration here is whether a grant is equity settled or cash settled. So equity settled, this is something like a stock option. You're typically going to value that at the grant date and then use that same valuation throughout the life of the option. Whereas you take something like a phantom or virtual stock option plan, these are cash settled plans, and in that case, you're going to want to revalue them every period and adjust the expense accordingly. So, you know, that is one kind of key difference between those two. Though you can use the Black-Scholes formula in both cases for running the actual valuation at the right time. But then you use, you know, those, there could be some differences there. Things can vary, but again, Ledgy, we've got support for all these. No problem with having a mix there.
And I think really important to get a sense of the degree of administrative overhead that's taken out of the equation when you can, in a piece of software like Ledgy, have your inputs right there for you, do the math, do the formula, and have something that's ready to actually use. Just to finish off, I think it's important to touch on in-house versus the third-party valuation question. I think, in your view, what difference does it really make when companies can access the frameworks and the bones of the IFRS 2 valuations inside your equity app, as opposed to having to go to a third-party valuation provider? Does it make a difference when you're thinking about your compliance requirements or your reporting period? Yeah, how does that shake out for companies?
Yeah, I think where the value lies doing this in a piece of software like Ledger is it really comes down to the fact that you can generate these expense calculations instantly. So the turnaround time is basically nil, as opposed to working with an external provider. It might take weeks or maybe in a bad scenario, even months to get back to you with all these expenses. And so especially if you're trying to move to a more frequent reporting period, like monthly, being able to do this efficiently and quickly can ultimately save you a lot of time and a lot of cost. And yeah, this is what we've seen with some of our customers are these kinds of needs. And they've definitely been very excited to get something that works this efficiently for them.
Super cool. And Alex, thank you so much for your insights on always a complex topic. Great overview of some of the key challenges around IFRS 2. And yeah, appreciate your time.
No problem. Thanks, Joe.
You have been watching 8-Minute Equity from Ledgy. And to learn more about making equity work for your company, just head to ledgy.com. Thanks very much for watching.